Today, we've got a real-life financial detective story for you. It's a puzzle that comes straight from the world of economic research. And the central question is this: how is it possible that two different groups of experts can look at the exact same thing, in this case, how companies invest their money, and come to two totally opposite conclusions? Let's dig in.
Okay, so take a look at this. This is the mystery, right here in two graphs. On the left, you've got the established, long-held view. The data is lopsided, showing that most firms are growing. But then a newer study comes along, and their finding is on the right, a perfectly symmetric world where it seems like companies are just as likely to shrink as they are to grow.
So this is our crime scene. One reality, two completely different stories. It's like one group is saying investment is a one-way street, mostly heading towards growth. And the other group says, nope, it's a two-way superhighway. And believe me, this isn't just some dusty academic debate. This gets to the heart of a really big, fundamental economic idea.
To really get why this is such a huge deal, we've got to understand the one core concept at the center of it all. It's a theory called investment irreversibility.
For decades, this has been a cornerstone of economics. And the idea is pretty intuitive. It says that companies are naturally cautious because it's a lot harder and more expensive to undo a big investment, to shrink, than it is to make it in the first place. So they think twice before making a big leap. And that caution, well, it should leave a clear footprint in the data. Here's a simple way to think about it. Building a new factory, that's relatively straightforward. But trying to sell an old, specialized factory, oof. You've got to find just the right buyer at just the right price. It can be a nightmare. And that difficulty, that friction in going backwards, is exactly what should create that lopsided graph we saw at the start. So you can see why that new, perfectly balanced graph throws a massive wrench in this whole theory. Okay, so a new team of researchers, let's call them our detectives in the story, they see this contradiction and think, wait a minute, something's not right here. So they decide to dig in. They pop the hood on the Challenger study and start looking at the data, and it doesn't take them long to find their first big clue. They found a pretty critical mistake, and it all has to do with something called depreciation, the normal wear and tear on a company's assets. The problem was the challengers were mixing and matching their numbers. They used one very specific firm-level number for depreciation in one part of their math, but then used a completely different broad industry average number in another part. It's like measuring something with a yardstick and then a meter stick and pretending they're the same. Just a total mismatch. And this chart really shows you just how big of a problem this was. Look at that difference. The general number they were using was less than half of the actual specific number that was already baked into their data. And what does that do? It systematically made it look like companies were investing way, way less than they really were. It literally pushed the entire graph to the left, creating the illusion that tons of firms are shrinking. And we are not talking about a small rounding error here. The second our detectives corrected this one single thing, the number of firms that looked like they were shrinking, it just collapsed. A huge chunk of the evidence for this easy reversibility just vanished. But the investigation was far from over. So even after fixing that first problem, something was still off. The data should have shown a bunch of high-growth companies, but they were missing, and that led our investigators to clue number 2. It wasn't just what they were measuring, it was who they were measuring. They discovered that the study was using a couple of really unusual filters. First, for every single company, they just threw out the first 3 years of its data. Gone. And second, they kicked out any company that made an acquisition worth just 5% of its assets, which, by the way, is a super low bar. Now, why is that such a big deal? Well, think about it. Who invests the most? Young, fast-growing companies and companies that are buying up other companies. These filters were almost perfectly designed to kick out the most aggressive investors, the very companies that create that fat right tail of growth that we would expect to see. And check this out. This table shows the impact on something called skewness. That's just a fancy stat for how lopsided the data is. The bigger the number, the more it's skewed towards growth. And look what happens. The moment our detectives turn off either of those strange filters, the skewness number just skyrockets. The data immediately starts to look lopsided again, just like it's supposed to. So at this point, our detectives have fixed the bad math and removed the biased filters. The data is starting to look right again. But the final graph in that Challenger study was still perfectly symmetric. How is that possible? They knew there had to be one more piece to the puzzle, so they went straight to the source, the computer code that ran the analysis. And that is where they found the smoking gun. This is it right here, a single line of code. And you don't need to be a programmer to understand what this does. It says, if you see a company that invested more than 20% in a single quarter, just delete that data point, make it disappear. This wasn't a filter. This was an explicit instruction to just erase the fastest growing data points from existence.
And that one little line of code, it had a massive impact. It wiped out over 4% of the entire sample. That's more than 14,000 individual data points. And here's the crucial part. Every single one of them was a high-investment observation. It was like taking a pair of scissors and just chopping off the entire right side of the graph to force it to look symmetric.
All right, so let's recap the clues. We have a fundamental data mismatch, we have biased filters that kick out the fastest growers, and we have the outright deletion of any high-growth data that managed to survive. The case is pretty much built. So now for the final verdict. What happens when you fix all of these issues? This is the moment of truth. Let's put all the pieces back where they belong and see what the real picture actually looks like.
And wow, the numbers here tell the whole story. The percentage of firms supposedly shrinking, it plummets from over 18% all the way down to under 6%. And at the same time, that skewness number, our measure of lopsidedness, more than doubles, confirming a very, very fat right tail of growth.
And this brings us right back to where we started, but now we have an answer. That symmetric graph on the left, it was an illusion. It was an artifact created by a series of data errors and deletions. The graph on the right, that's the reality. Once you correct the data, it once again shows a heavily asymmetric distribution, just like the theory of irreversibility predicted all along. So, the mystery is solved. The case of the disappearing data is officially closed. The fundamental economic idea that it's harder for firms to shrink than to grow, it appears to be correct after all. The data, when you handle it properly, fully supports it. You know, in the end, this financial detective story isn't just about one study. It's a powerful reminder of how science and research are supposed to work. Progress isn't just about finding new things. It's about going back and checking the work that's already been done. It shows why it's so incredibly important to not just accept findings at face value, but to always be willing to pop the hood, look at the code, and ask the tough questions.